Greetings everyone and welcome to lesson 39. In this video, we are going to talk about a simple topic called as arbitrage. We'll talk about what is the definition of arbitrage, how it is done in Indian market, and we are also going to talk about few examples. So let's start. Before I start about arbitrage, I also want to tell that when I usually speak about arbitrage in my classes, a lot of people confuse arbitrage with hedging. Now, to those who don't know what is hedging, they can check out our video on hedging. It's in the previous videos. You can just search around in my playlist. You will get a video on hedging and you can completely learn about hedging and come back here. Now, for those who have already learned hedging, for them, I want to also tell that hedging and arbitrage are completely two different topics. But in my seminars, in my webinars, when I first talk about arbitrage, a lot of people have a misunderstanding that hedging and arbitrage are one and the same. It is not. So what exactly is arbitrage? Let us try to understand that. So arbitrage is basically catching price difference between two different or similar platforms in same or similar script. Now what do you mean by this? It means you're catching a price difference between two identical scripts which can be in a same exchange or in other exchange or in same segment, that is in derivative or equity or options, but they have a small price difference. Now if I have to give you a theoretical example, then consider, let us say you want to buy lemon. Now if you will go to buy lemon from the nearby grocery store, let us say Big Bazaar, you might get lemon at, let us say, 3 rupees per piece or maybe 4 rupees per piece. But if you go to the vegetable market of your city or your town, you might find the same lemon at 1 rupee per piece. Now the lemon is exactly the same. However, there are two different platforms. One is a supermarket like Big Bazaar. The other is your local vegetable shop. Now, if you buy lemon at 1 rupees from vegetable shop and sell it in Big Bazaar for 4 rupees, you're basically catching the price difference between two different platforms for the same script or the same underlying. And that process of catching price difference is called as arbitrage. Now, how do you catch such spreads or such price difference in Indian market? In our previous videos, I've already explained to catch price difference in options in a video topic called as box spread. So you can also see that video as your reference, how you can catch price difference between calls and puts to make risk-free money. That is called as arbitrage. Similarly, not only options, you can do arbitrage in equity and future as well. I'll give you some examples in today's lesson. But before that, let us talk about few more points about arbitrage. Now arbitrage, as said, is basically catching the spread and it gives you almost 100% risk-free return. Now if I talk about box spread itself, you might have seen that in box spread also we almost made 100% risk-free return. Similarly, in the examples that I'm going to show you today as well, arbitrage will basically help you give 100% risk-free returns. However, the one important factor that you need to remember is that although the returns are 100% risk-free, the returns are very small. It might be say 1% or 0.5% of your principal. So it is always advised before taking an arbitrage to check the transaction cost and break-even point. Suppose say if your broker is charging you very high and you are trading into a segment where your transaction charges, SEBI charges and other charges are also very high, and the profits that you are making using arbitrage are lower than the tax and brokerage, then there is absolutely no point in taking such spread, because there you will be making a very small profit but your tax and brokerage will be so high that at the end of the day you will be paying from your pocket rather than earning money. So it is always advised to check the transaction cost and break-even points as the first thing before you implement arbitrage in the live markets. So let us try to understand arbitrage in more detail. I'll give you a small example where we can apply arbitrage in Indian market, especially mixing Indian equity market and Indian future market. So for example, now consider an X stock whose current market price is say 100 rupees in equities. We also know that future prices are generally greater than equity price. Now again, if you have not seen our videos on futures, do check them out. In fact, before coming to lesson number 39, watch all the video from lesson 1 to lesson 38 to understand everything in detail. Right, so moving ahead, let us say you're trading in futures as well. The same X stock whose current market price in future would be a little bit higher, say maybe 101 in futures. Now let us say the future lot size is 5,000. So what I have to do to set up an arbitrage is I have to buy 5,000 shares of X stock at 100 rupees in equity, and I have to sell one lot, or I have to short one lot in futures. So I am buying in equity and I am shorting or selling first in future at 101. There is a 1 rupee price difference. Now on the day of expiry, this 1 rupee difference between equity and future will be my risk-free profit no matter in which direction the market goes. Let me explain you how it works. Say here I write 100 rupees in equity, and here I write future 101, short future and buy equity. Now since the quantity is same, 5,000 and 5,000, I am not mentioning the quantity. Let us say on the day of expiry, the equity price has gone up to 110. Now we also know that on the day of expiry, future price and equity price are same, because F is equal to S naught into e to the power of RT, which becomes 0 on the day of expiry. So F is equal to S naught on the day of expiry. So future price is almost same as spot price on the day of expiry. So future price will also be 1110 on the day of expiry. That means in equity you are making 10 rupees profit, but in futures you are only losing 9 rupees. So net to net you are making this 1 rupee profit. Similarly, if the market falls down to say 90, then future price would also go down to 90. So in equity you're losing 10 rupees because you bought at 100, you're selling at 90. But in futures you're making 11 rupees because you sold at 101, you're buying back at 90. So essentially you're making 11 rupees. You're losing 10, you're making 11. So you're risk-free making 1 rupee return. So 1 into 5,000, that is 5,000 is your risk-free return. Now you also have to calculate how much is the brokerage and taxes you have paid. Apart from that, after deducting all of that, your net profit would be somewhere around say 4,700 or 4,600. So that is your risk-free return. Now again, a lot of people might ask me, if arbitrage is giving risk-free rate of return, why is not everyone doing arbitrage? The reason is that arbitrage gives you a very small profit and a big investment is involved. For example, see here, to buy 5,000 shares of equity at 100 rupees, I need 5 lakh rupees in equity, and to short one lot of future we need total margin which is somewhere around 2 lakh. So approximately 7 to 8 lakh rupees is needed to just earn what, 4,000, which is almost 0.5% return in a month, because I have to wait for the entire month. And that is why a lot of people do not prefer doing arbitrage, because the returns are almost same as the return in a standard FD. However, very rarely you get a very big spread, and even those spreads are usually captured by high frequency trading machines or special arbitrage catching machines used by FII, DII and mutual fund owners, because of which we as a retailer do not see a very big spread. However, arbitrage, if caught properly, can give you risk-free very good returns. So this was about arbitrage. In the next lesson, from next lesson onwards, we will talk a lot about strategy creations. Now, in my last few videos, a lot of people have asked in the comment section, give us an intraday strategy, give us a profitable intraday strategy, give us a winning strategy. So I finally decided that now that I have taught almost everything that I know about stock markets, I can now focus upon teaching you strategies which are best for intraday. So in our next lesson, we'll be focusing upon strategies. We'll be basically exploring a lot of profitable strategies. Not only will be exploring just the logic part, we'll also talk about backtest result of the strategies. That means, are the strategies only good to talk about, or they're actually giving us profit? We will see the historical performance of those strategies as well. Not only historical performance, taking a step ahead, I will also implement that strategy in the live market. I'll trade in the live market, I'll record my screen in the live market, and I'll also show you whether I actually made profits or not by following the strategy that I'm teaching you. I'll talk about all of this in the next video only when I have 5,000 subscribers on my YouTube channel. Currently we are close to 4,000 subscribers. I need 1,000 more subscribers. So what you have to do is you have to basically share it with your friends, like this video, subscribe to the channel, and share it with your friends as much as possible, so that we can grow to the family of 5,000 and I can release much more interesting videos for you guys. Thank you so much, and I'll see you in the next video.